So this is the second video in this series of Property Developers Mastery, where we're going to talk about how you structure your business for maximum cash flow and capital appreciation. One of the misconceptions people get into property is that they're going to generate substantial wealth from their investment portfolio, and I'm primarily talking about residential property investment. So if you've got a portfolio of buy-to-lets, HMOs, rent-to-rents, serviced accommodation, whatever kind of strategy that falls into that, where somebody pays you an amount monthly, weekly, or whatever the particular model is, and you receive cash coming in, you pay your expenses out of that, and you've got a cash flowing property. It's a very, very slow process in order to build wealth, because what really happens is that you don't have a lot of net cash coming into the business after you've paid for your mortgages, insurance, and all the other expenditures that come with a property investment portfolio. Yes, you can get there. It will generally take you 10 years to get to the point where you could probably quit your job and you'd have enough money to survive. It wouldn't necessarily give you a wonderful lifestyle, but it would certainly replace your current income. And of course, that would depend on what your current income is. Whereas what we believe in is that you need to have cash flowing is great, but also you need to have property development, which provides you with chunks of cash, so as that you can then basically move your wealth gain further ahead. So let's just look at this just briefly. So if we have, we'll just phrase this under as buy-to-let. So, and it covers all those different aspects, whatever buy-to-let is for you. And then we've got here, and we'll talk about property development. So we'll just call that PD. And so what you're doing here is you're getting cash flow out of these properties, depending on how many you've got, and you're creating chunks of money. And so what you should be doing here is you should be generating a profit of somewhere between 25 and 33% from your property development projects, and that's based on gross development value. So what I would suggest you do is that you have a look in your local area and see the type of properties that you might build and see what they're kind of selling for. The best sort of like development sites that you're looking for are probably somewhere between 4 and 9 houses to put on there. So if you simply take, say, let's say 4 houses, and let's say those houses are selling for 300,000 each, then that'd be 1.2 million. So 1.2 million, then you're looking at a cash outtake of that of somewhere between 300,000 and 400,000 that you would do once you've got a completed property development project. What you can then do is then use some of that money to actually advance your property development business, but you can also do two things here. You can either buy more of these properties here and increase your cash flow, or another, and I think perhaps a bit more sensible way, is actually to reduce the amount of debt, which will in effect then increase the amount of cash flow that you have coming from this. You can also create cash flow from here, because what you would do is the way that you actually structure your business is that you would have your development company, but then you would have your project company. So this would be project, and this would be development company. And so this development company is hired by this company, which is doing the development project, to actually complete the build out. So there's a good reason for doing this. Partly is that if there's any risk and you've got several projects going on at the one time, and something happens with one of those, for instance, maybe a child walks onto the site and you suddenly get sued, then it could affect the profitability of that. But this, because you got it in 2 different companies, has protected you from the liability of this one. So each project would have its own development company, but the main company would be the main contractor. And so as the main contractor, they're going to charge a markup on the materials and labor that they supply to carry out this development, which means that there's income coming into this company, and then you, as a director of this company or employee of this company, you can pay yourself a salary so that you're actually getting paid while the development is in process. And then obviously you will create the chunks of money which will then help you either reduce the debt on your buy-to-lets or allow you to purchase more buy-to-let properties. So that's kind of how I would suggest that you actually structure your business. Obviously there's lots of legalities that come into there, and I would definitely advise you to seek professional advice on this. We will be actually developing a program so that we can show you how to actually take the goal that you might have. You might have a particular wealth goal or particular time freedom goal that you want to achieve, and so we'll be able to show you how you actually achieve that. So if that's something that interests you, then just put something in the comments below, just saying development project, something like that, and then I will know that you're interested in that, and I will contact you once we release that particular program to you. So on the next video, we're actually going to get into the nuts and bolts of property development, and we're going to look at finding land. So remember to subscribe to the channel if you haven't already, so that you don't, and hit that notify button so that you are notified when the next video is released in this series.